There's a number climbing on a digital clock in Times Square that most people walk past without thinking twice about: $38 trillion. It hit that milestone on October 23rd, 2025. But if you know your history, that number should feel familiar. Not the amount, that's unprecedented, but the situation. Because every major empire that accumulated debt it couldn't repay faced the exact same choice we're facing now. In 264 AD, Emperor Nero faced a similar problem. Rome's treasury was empty after years of excessive spending. He couldn't raise taxes. The provinces were already in revolt. He couldn't default. That would collapse Roman trade. So he did something simpler. He recalled all the silver denarii coins and reminted them with 50% less silver content. Same coin. Half the silver. Rome paid its debts with currency that was worth half as much. Brilliant, if you ignore the angry citizens. In 1923, the Weimar Republic owed reparations it couldn't pay. They chose the printing press. By November, it took 4 trillion marks to buy a single US dollar. The debt disappeared, but so did the German middle class. Problem solved, you might say, depending on which side of the printing press you were standing. In 1945, the United States emerged from World War II with debt at 119% of GDP, higher than today. They didn't default. They didn't impose brutal austerity. They inflated it away over a decade while pretending nothing was happening. History doesn't repeat, but it rhymes. And right now, America is humming the same tune that's been sung by every empire that reached this point. The question isn't whether they'll inflate away $38 trillion. The question is whether you'll recognize it while it's happening. Let me show you the exact playbook they're using, because it's not new. It's the same strategy America used after World War II, and it worked so well that most people don't even know it happened. In 1945, U.S. federal debt stood at 117% of GDP. The government owed $260 billion, an astronomical sum for the time. And they had a problem. The economy was transitioning from wartime production to peacetime. Millions of soldiers were coming home. Defense spending was collapsing. Standard economic theory said this should trigger a depression. The government should have raised taxes dramatically or slashed spending to pay down the debt. But they knew that would be political suicide and economic catastrophe. So they did something different, something quiet. The Federal Reserve and the Treasury made a secret agreement called the Accord. The Fed agreed to keep interest rates capped at 2.5% on long-term government bonds. Meanwhile, inflation was allowed to run at an average of 6% throughout the late 1940s and early 1950s. Do the math. If you're earning 2.5% on bonds, but inflation is running at 6%, you're losing 3.5% per year in purchasing power. This is called a negative real interest rate, and it's financial repression, forcing savers to accept returns below inflation, a perfectly civilized form of theft, really. This policy ran for nearly a decade, and it worked brilliantly, if you were the government. By 1955, the debt-to-GDP ratio had fallen from 117% to just 66%. The debt hadn't been paid down. It had been inflated away. Every bondholder who thought they were safely lending to the government lost about 35% of their wealth in real terms. But here's the crucial part. Nobody rioted. There were no protests. Most Americans didn't understand what was happening to them. The newspaper headline said, "Prosperity returns." The stock market was booming. Housing prices were rising. People felt wealthier even as the purchasing power of their savings evaporated. This is the model. This is what they're doing right now, but on a scale that makes 1945 look like a practice run. Throughout history, governments facing unsustainable debts have had 3 choices. Let me show you what happened each time these options were tried. Option 1, austerity. Britain tried this after World War I. They returned the pound to the gold standard at its pre-war value in 1925, which required brutal deflation. They raised taxes. They slashed government spending. They drove unemployment to 15%. The result? The General Strike of 1926, the largest labor action in British history. 3 million workers walked off the job. The policy was politically unsustainable and economically devastating. By 1931, Britain was forced to abandon the gold standard anyway. All that pain for nothing. The lesson: democracies cannot sustain the level of austerity required to pay down massive debts. The political system breaks before the debt does. Option 2, explicit default. Russia tried this in 1998. The government simply announced, "We're not paying." Overnight, the ruble collapsed by 75%. The stock market fell by 90%. Banks failed. Millions lost their life savings. Argentina has defaulted 9 times in its history. Each time, the result was economic chaos, capital flight, and a generation of poverty. When you default explicitly, international credit markets close. Foreign investment stops. Your currency becomes untradeable. For the United States, the issuer of the global reserve currency, this option would be catastrophic beyond measure. Every pension fund, every central bank, every insurance company in the world holds U.S. Treasuries as their risk-free asset. If America defaults, the entire global financial system has no foundation. So, that's off the table. Unless we're aiming for a global financial apocalypse. Option 3, the soft default. This is the path every major empire eventually chose. Rome debased the denarius over 3 centuries, reducing its silver content from 100% to 5%. Each emperor shaved a little more off the coins to pay the army. Slow and steady wins the race, apparently, even in currency destruction. France inflated away its debts after the Napoleonic Wars. Britain did it after World War I and II. Every Latin American country did it in the 1980s during the debt crisis. The pattern is always the same. Keep interest rates below inflation for an extended period. The nominal debt gets repaid in full, but the currency it's repaid in is worth substantially less. It's a default, by another name, one that doesn't trigger immediate collapse, but slowly transfers wealth from creditors to the state. In 1923 Germany, this happened catastrophically fast. The government printed money to pay war reparations, and inflation spiraled out of control. A postage stamp cost billions of marks. Workers demanded to be paid twice daily so they could spend the money before it lost more value. Not exactly a sustainable economic model. But most historical inflations happen slowly. The Roman debasement took 300 years. Post-war Britain took 2 decades. The trick is to do it slowly enough that people adjust their expectations gradually so they don't panic and flee the currency all at once. That's what America's attempting now. A controlled, slow-motion, soft default that will take a decade or more to fully play out. To understand what's happening today, you need to understand August 15th, 1971. That was the day the modern monetary system was born, and the day America first chose inflation over honesty. After World War II, the global monetary system was built on the Bretton Woods Agreement. The US dollar would be backed by gold at $35 per ounce. Every other currency would be pegged to the dollar. This system provided discipline. The US couldn't print unlimited dollars because foreigners could demand gold in exchange. By the 1960s, that system was under strain. The U.S. was running large deficits financing the Vietnam War and President Johnson's Great Society programs. Dollars were flowing overseas, and foreign central banks started getting nervous. France, under President Charles de Gaulle, actually sent warships to New York Harbor to physically collect gold in exchange for dollars. Nothing says, "we don't trust your currency," quite like showing up with battleships. By 1971, the U.S. had printed so many dollars that if every foreign holder demanded their gold, Fort Knox would be empty. The Treasury held $13 billion in gold but owed $55 billion to foreign creditors. The math didn't work. On August 15th, President Nixon went on television and announced the U.S. would temporarily suspend the convertibility of dollars to gold. That temporary suspension has now lasted 54 years. It was a default, not on the dollar debt itself, but on the promise that dollars were backed by gold. Temporary, like so many government programs. Within 2 years, the dollar had lost 30% of its value against gold. Foreign central banks holding dollars had been quietly robbed. But there was no alternative. The dollar was still the only currency that could facilitate global trade at scale. This is the crucial precedent. When America faced the choice between painful discipline and monetary expansion, they chose expansion. And the world accepted it because there was no viable alternative to the dollar system. We're at a similar inflection point now. The debt is unsustainable. The options are limited. And history suggests the government will choose the path of least resistance. Monetary expansion disguised as necessary policy. Now, let's connect this history to the present crisis. In 2020, the average interest rate on U.S. government debt was 1.6%. The government was paying about $400 billion a year in interest. Today, that average rate is 3.4%, and the annual interest bill just crossed $1 trillion. This is where history becomes mechanical. In 1945, the government could keep rates at 2.5% because they had explicit control. The Federal Reserve was subordinate to the Treasury. Today, the Fed is supposedly independent. But as debt grows, that independence becomes theoretical, more like a polite fiction, really. Here's why. If the Fed allows rates to rise to where they naturally should be, 6 or 7% given current inflation and deficit spending, the interest bill would explode to $2.4 trillion per year. That's nearly half of all federal tax revenue just to pay interest. At that point, only 2 things can happen. Either the government slashes spending by 50%, which means cutting Social Security and Medicare in half, or the Federal Reserve steps in to buy government debt and artificially suppress rates. We know which option they'll choose because we've seen this movie before. In 1942, when the Fed tried to maintain independence, the Treasury simply told them, "You will buy our bonds at 2.5% or the government shuts down." The Fed complied. They had no choice. Independence is lovely until someone threatens to turn off the lights. This is called fiscal dominance, when the debt becomes so large that the central bank loses its independence and becomes a subsidiary of the Treasury. It happened to Britain in the 1940s. It happened to Japan in the 1990s. And it's happening to America right now. Every historical debt crisis had the same four players, and someone always lost. Let me show you who won and who lost in past episodes. Post-World War II America, 1945 to 1955. The winners? The government. Debt to GDP fell from 117% to 66%. Homeowners and stock investors, asset prices rose with inflation. The losers, bondholders, and savers lost 35% of purchasing power over a decade. But they got to feel patriotic while being robbed, so there's that. Britain, after World War I, 1925 to 1931, winners, nobody. Britain tried to protect bondholders through austerity, which destroyed the economy. Losers, workers, 15% unemployment. The government, forced to abandon gold standard anyway. A complete disaster all around. Weimar Germany, 1921 to 1923. Winners. The government debt effectively went to zero. Debtors, mortgages became worthless. The losers? The entire middle class, life savings evaporated. Anyone holding marks or German bonds. And we all know how well that turned out for political stability. Latin America debt crisis, 1980s. Winners. U.S. banks got bailed out by IMF. Wealthy who moved money offshore. Losers. Local populations. Lost decade of economic growth. 40 to 60% drop in living standards. The pattern is clear. In every case, the group that holds currency or fixed-rate bonds loses. The group that owns real assets or has access to the money printing mechanism wins. Right now, we have Player 1, the U.S. government with $38 trillion in debt. Player 2, the Federal Reserve, losing independence. Player 3, foreign creditors holding $7 trillion in treasuries. And then Player 4, the American savers and bondholders. History tells us players 3 and 4 are about to get quietly robbed, just like in 1945. The only question is the timeline and the magnitude. The mechanics of modern financial repression are more sophisticated than in 1945, but the principle is identical. Let me show you the 3 tools they've upgraded. Tool 1, the captive buyer system. After the 2008 financial crisis, regulators created something called Basel III standards. These rules require banks to hold high-quality liquid assets, which means U.S. treasuries, regardless of their return. This is the modern version of what the U.S. did in 1942. Back then, the government issued victory bonds and pressured citizens to buy them through patriotic campaigns. Banks were encouraged to hold government debt. It was soft coercion. Today, it's hard-coded into law. Insurance companies, pension funds, and banks must buy treasuries to stay in business. This creates artificial demand that keeps yields lower than a free market would bear. It's not coercion if it's a regulation, apparently. Tool 2, the broken inflation gauge. The government officially calculates inflation using the Consumer Price Index, but the methodology has been systematically altered since the 1980s to understate true price increases. This isn't conspiracy theory, it's public, documented policy. In 1980, the Bureau of Labor Statistics changed how they calculate housing costs. Instead of tracking home prices, they track rental equivalents, what homeowners theoretically would pay to rent their own home. When housing prices exploded in the 2000s, official CPI barely budged. Convenient. They introduced substitution bias. If steak gets expensive, they assume you buy chicken, so they track chicken prices instead. They introduced hedonic adjustments. If your laptop costs more but is faster, they say the price didn't really increase because you're getting more value. If we calculated CPI using the 1980 methodology, current inflation would be 7 to 8%, not 3.5%. This matters because Social Security payments and Treasury inflation-protected securities are indexed to CPI. Every percentage point they understate saves the government tens of billions per year. Funny how that works. Tool 3, the Federal Reserve put. On December 10th, 2025, the Federal Reserve announced they would purchase $40 billion in Treasury securities per month. They're calling it reserve management, not quantitative easing. Different name, same printing press. This is the modern version of what the Fed did from 1942 to 1951 when they were forced to buy government bonds at fixed prices. It's debt monetization, the central bank creating money to buy government debt. The Fed's balance sheet went from under $1 trillion in 2008 to $9 trillion at its peak in 2021. That's $8 trillion in newly created dollars used to purchase government and corporate bonds. Without these purchases, yields would be 3 to 4 percentage points higher. These three tools working together create the same financial repression that liquidated the debt after World War II. The execution is more sophisticated, the legal framework more complex, but the outcome is identical. Savers lose purchasing power, the government's debt burden shrinks in real terms. But there's a crucial difference between 1945 and today, the international dimension. After World War II, the U.S. was the only major economy with its infrastructure intact. The dollar became the global reserve currency by default, not because of manipulation, but because European and Asian economies were rebuilding from rubble. When America inflated away its debt in the 1940s and 50s, foreign holders of dollars had nowhere else to go. The British pound was weak, the German mark didn't exist yet, the Japanese yen was worthless, the French franc was unstable, there was no alternative to the dollar. Today, that monopoly is breaking down, and history shows what happens next. In the 1960s and 70s, as America printed dollars to finance Vietnam and domestic spending, foreign central banks started diversifying. France, as I mentioned, actually sent ships to collect gold. By 1971, the dollar's monopoly was challenged enough that Nixon had to abandon gold convertibility. We're in a similar moment now. In 2024, China reduced its treasury holdings by $100 billion. Saudi Arabia is accepting yuan for oil payments, breaking the petrodollar system established in 1973. Russia conducts 90% of its trade with BRICS nations in local currencies. Central banks are buying gold at the fastest pace since the 1970s. China's central bank bought gold for 11 consecutive months. This is exactly what happened before the collapse of Bretton Woods, foreign creditors losing faith in dollar stability and fleeing to gold. The historical pattern is clear. When foreign creditors lose confidence, the monetary hegemon loses its ability to export inflation. When Rome's provinces stopped accepting debased denarii, Rome had to pay soldiers in better currency or face mutiny. When the British pound lost reserve status after 1945, Britain faced a decade of currency crises. America has perhaps 5 to 7 years before this de-dollarization reaches critical mass. Once foreign demand for treasuries collapses completely, the Federal Reserve becomes the only buyer. At that point, the printing press runs full speed, and the inflation that's been gradual becomes rapid. Now let me show you the most elegant part of the plan, one lifted directly from Franklin Roosevelt's playbook. In 1934, after confiscating gold from American citizens through Executive Order 6102, Roosevelt revalued gold from $20.67 per ounce to $35 per ounce. Overnight, the government's gold reserves increased in value by 69%, about $3 billion. Enormous for that era. This wasn't just theft from citizens who'd surrendered their gold, it was balance sheet engineering. The Treasury suddenly had billions more in assets, which allowed them to issue more currency and extend more credit. The debt-to-GDP ratio improved not because debt fell, but because the asset side of the ledger grew. Accounting magic at its finest. They're preparing the same mechanism today with two assets, gold and Bitcoin. The U.S. government currently values its gold reserves at $42.22 per ounce. The statutory price set in 1973. The government holds 8,133 tons. At the official price, that's about $11 billion on the books. At current market prices of $2,700 per ounce, it's worth over $700 billion. The government could announce tomorrow that gold is being revalued to $10,000 per ounce for reserve purposes, not to buy or sell, just for accounting. Instantly, their balance sheet shows $2.6 trillion in gold assets. Roosevelt did this in 1934 for precisely this reason, to create room for monetary expansion by making the asset side of the government's balance sheet look stronger. Bitcoin offers an even more dramatic opportunity. The government holds approximately 328,000 Bitcoin seized from criminal cases, about $33 billion at current prices. If they declare Bitcoin a strategic reserve asset valued at $500,000 per coin for accounting purposes, that becomes $164 billion, a $131 billion paper gain. This is pure Roosevelt. Create trillions in paper assets through revaluation, use that to justify continued borrowing, and let inflation do the rest. The accounting shows fiscal strength while the currency weakens. It's so elegant you almost have to admire it. There's one more historical parallel that should terrify anyone who knows monetary history: the movement towards central bank digital currency. Throughout history, governments facing debt crises needed to control capital flows. In 1933, Roosevelt didn't just confiscate gold, he made it illegal to own. Why? Because gold was an exit door. If citizens could hold gold, they could escape currency debasement. In Weimar Germany, the government imposed capital controls in 1923, making it illegal to hold foreign currency or move money abroad. Those who escaped the hyperinflation were those who violated these laws early. In the Soviet Union, it was illegal to possess foreign currency. The government maintained complete control over money because all transactions flowed through state banks. The pattern is always the same. When a government needs to implement financial repression, they first need to eliminate exit doors. Physical cash and gold are exit doors. Foreign currency accounts are exit doors. Anything that lets you opt out of the domestic currency is a threat to the policy. This is what CBDCs accomplish. If every dollar is digital, if every dollar exists only as an entry in a Federal Reserve database, there are no exit doors. You cannot withdraw cash. You cannot hide wealth. Every transaction is visible and controllable. For your safety and convenience, of course, China's digital yuan already has this functionality. The government can see every transaction, block certain purchases, and even set money to expire if not spent. They can implement negative interest rates by simply deducting balances monthly, forcing spending by making saving impossible. The Federal Reserve is running pilot programs right now. When the digital dollar launches, and it will be sold as convenience, security, and modernization. What they won't advertise is that it's the final infrastructure needed for complete financial repression. Once cash is eliminated, they can implement the exact policies that worked in 1945, but with precision impossible then, they can set your savings to lose 2% per year automatically. They can force you to spend stimulus payments within 60 days. They can prevent capital flight with code instead of laws. The historical lesson is clear. Governments implementing financial repression always eliminate the exits first. Based on historical precedent, let me show you the probable timeline, 2025 to 2027. The setup. Fed bond purchases expand to $80 to $100 billion monthly. This mirrors 1942 to 1945, when the Fed was forced to buy bonds at artificially low rates. Official inflation runs at 3 to 4%, real inflation at 6 to 8%. 2027 to 2029, the acceleration debt crosses $40 trillion. Foreign treasury holdings drop below $6 trillion as de-dollarization accelerates, similar to the 1960s when France and others started demanding gold. The Fed becomes the dominant buyer of new debt. 2029 to 2031, the revaluation, gold gets officially revalued on government books, potentially to $5,000 to $10,000 per ounce. Bitcoin possibly declared a strategic reserve. This creates 2 to 3 trillion in paper assets, exactly like Roosevelt's 1934 gold revaluation. 2031 to 2033, the digital transition. CBDC rollout begins. Initially voluntary becomes mandatory within 2 to 3 years as cash is phased out. This is the modern version of gold confiscation. Not taking your assets, but eliminating alternatives. 2033 to 2037, the full liquidation. Real inflation runs at 6 to 8% sustained. The 40+ trillion debt gets cut in half in real terms over this period. This mirrors the 1945 to 1955 debt liquidation, but compressed into a shorter time frame. The historical parallel is almost exact. The only differences are scale and sophistication. In 1945, they did this with telephone calls and paper ledgers. Today, they do it with algorithms and digital ledgers. But the outcome is the same. Bondholders lose 30 to 50% of purchasing power. The government's debt burden evaporates. History is clear. No major empire has ever paid down debt of this magnitude through honest means. Rome debased its currency. Britain inflated after both world wars. America did it after 1945. Weimar did it catastrophically. Every Latin American country did it in the 80s. The invisible tax is already being collected, just as it was in 1948. Every month, you hold dollars earning 4% while real inflation runs at 7%. You pay 3% of your wealth to the government, exactly as bondholders did in 1948. The winners in every historical episode were those who owned real assets: land, businesses, commodities, gold. The losers were those who trusted paper promises: bondholders, savers, people on fixed incomes. But there's a darker chapter to this story, one that shows just how far governments will go when financial repression isn't enough. In 1933, the U.S. government made it illegal to own gold. Executive Order 6102 sent federal agents door-to-door confiscating gold under threat of 10 years in prison. Then, after seizing everyone's gold, they revalued it 69% higher, transferring billions from citizens to the government overnight. That legal precedent still exists. In the next video, I'm going to show you the full story of the Great Gold Confiscation, how it was justified, who escaped, and why the exact same presidential powers could be used today to seize Bitcoin, gold, or even retirement accounts during a declared emergency. History doesn't repeat, but it rhymes. And right now, you can hear the rhyme clearly if you know what to listen for. Hit subscribe, drop a comment with the historical parallel you found most relevant, and I'll see you in the next one. I'm Malcolm, and this is History Meets Economics. If you think this documentary is wrong, explain where. If you think it's right, explain. Here's another moment where history met economics.